Coming up, the US economy expands, so what will the Fed do with interest rates next week? And retailers on watch as the cost of living bites. That's all next. It is your daily 10-minute business and finance news wrap for this Friday, the 27th of October, 2023. Later on Market Day, we'll speak with Grady Wulff from Bell Direct. But first, to the US economy, where GDP expanded a better than expected 4.9% annually in the third quarter. For more on the US economy, I spoke with Steen Jakobsen. He is the Saxo Market Chief Investment Officer. Steen, first of all, the US economy expanded a stronger than expected 4.9% in the third quarter. Yes, it comes off a low base, but there are still signs that consumers are spending despite tightening conditions. How would you describe the US economy at the moment?
It's a great question, Ricardo, and it goes to the center of the policy choices that we face, not only in the US, but also in Australia. Why is the economy so strong as it is in terms of the number that we see, in terms of the statistics? And the reason is that the fiscal dominance, i.e. the government's hand in this, is very, very big. In the case of the US, you use the tax bracket up. So people on low income, of course, needs to make far more money before they actually reach a threshold by which they pay a certain amount of tax. That has helped. The fact that the COVID, as we all know, was a huge transfer of wealth from the public sector to the private sector. It's simply taking us longer than we expected to run down that amount of money. But as you and I talked today, Richard, I think this is probably the final good number we're going to see out of the US, because if we look at the forward guidance in terms of what the companies that reported so far has done, but also if we look at the cost to the consumer, let me just stress that the credit cards now in the US is 24%. A mortgage is 8%. And if you want to borrow money for a car in 5 years, it's 8.5%, 10%, which is 2x what it normally is. So in other words, yes, we've been having a great tailwind. Yes, we got the confirmation of the number, but it's very likely the Fed is now done and dusted. And to be honest, I know down here you have a conversation about RBA, but trust me, they're not going to go any further in terms of hikes.
Can we go into that in more detail? First of all, on the US, on the markets, we're seeing higher bond yields. Putting all of this together, you reckon that the US Fed is done? It's meeting next week. So what do you think they're going to be talking about?
I think they increasingly will be focused about the Middle East. They will increasingly be focused about the fact that the bond market is telling them very, very loudly and very, very clearly that they are concerned by the amount of debt that the government issues. Of course, that is not in the remit of the Federal Reserve, but it's certainly something they need to react to. So in other words, we are nearing a point or a conversation that we had 1 year ago. You remember we all talked about, okay, if Fed is going to go higher for longer, what would eventually happen is that something will break. I think something is breaking. The cracks in the wall is not showing up yet, but I think it's about to come. So in other words, Fed knows this. First, Fed is already concerned. We know from market players that they are checking the liquidity. And what they face is that, yes, the recession will come. When, how is sort of the question. But in terms of the market functioning, we are getting more and more concerned. And if you look at every single Fed cut since 98, pretty much, it's all been driven by illiquidity market or a market event. We could be getting to that point where things are broken and where the actual catalyst will be the market functioning and the safety of the market functioning that will sort of prevail in their thinking.
You mentioned the conflict in the Middle East. That's one major global risk. To what extent does it worry you?
I'm seriously concerned, but I'm an old guy, Ricardo, unlike you, and I've seen too much in the world to just put it to the wayside. I think what we traders like to talk about is geopolitical risk premium. No one believes in it because they say, oh, every time something happens now, it's not worth it. But listen, 9/11 was the single biggest attack on privacy, on property rights. It created the narrative of us against them. That got worse by the Ukraine war, and now we have the Middle East. All of it to do with them against us. It has increasingly, unfortunately, to do with religion, religious belief. It has to do with that we are aligning in new alliances. We are living in a fragmented world. To think that that will not have an impact, maybe not today, maybe not next week, but over the course of the next 5 year, 1 decade, we're going to see trading routes being changed. We see the new super BRICS countries. They have 6 of the world's biggest oil exporters and the 2 biggest importers. Is that going to change the world? Of course it will, Ricardo, sorry.
You mentioned the Reserve Bank as well. The big 4 bank economists in Australia, ANZ, Westpac, NAB, the Commonwealth Bank, they're all now expecting the RBA to lift interest rates on Melbourne Cup Day here in Australia from 4.1 to 4.35%. A lot of it, off the back of these stronger than expected inflation numbers. What's your feel? What do you think the RBA is going to do? I think you just said the RBA is done. And does that mean they may have gone too hard, or the delayed effect of these rate rises are still yet to come?
They're still yet to come. And to be honest, it doesn't really matter whether they hike or not, because they are done with the overall cycle. Even if they do hike, the market will see it as being the final hike. So in terms of the impact on the interest rate, it's probably we see a downward trajectory. But you have to remember, Fed meets next week before the RBA. And as much as I love Australia, as much as you guys love your own country, the lucky ones, and so forth. But the fact is, you are driven by an external factors, and the biggest external factor for you is U.S. monetary policy. And if the Federal Reserve is done, then RBA is also done. So I don't like to disagree with my peers. They're smarter than me. They're probably better looking as well. But the point here is that you are in a international cycle where the geopolitical risk in the Middle East is increasing. And the central bank is just hawkish for the sake of being hawkish. And for the record, central banks have no predictability. I have a dog called Nelly. She's a golden retriever. She's better at predicting economics than any central banker.
In wrapping up, if the US Fed is done in lifting interest rates, what does that mean for global investments? And is the market already priced in for that, for example?
I don't think it is fully. I think 1 year ago, everybody's willing to sign on to the recession call. But what you need, and what the question pertains to, is really, you want me to handicap the sort of the changes to recession, to the economy, and that recession into the valuation of the stock market and into the bond market, times sort of what is going to happen. And the difficulty here, of course, that recession on itself will lower the interest rate, but that lower interest rate comes on the back of a lower economic activity, which means that delinquency and bankruptcy, and probably finally in the case of Australia, a little bit of a weaning, sort of lower prices in the prices. And certainly, I know everyone, your barber, your local grocery store, they are really troubled right now by the cost of energy, the cost of electricity overall, the increased burden on them to be regulatory compliant. So net, it's unfortunately slightly negative, but not something that people should go to bed tonight and or online, even worse, to book a ticket for Noah's Ark. We are just for once in 20 years, we probably will live through a real business cycle, meaning some people will be go into bankruptcy, some people will need some additional help, but net, we are moving to a better place from a worse place.
Steen Jakobsen there, the Chief Investment Officer at Saxo Markets.
Now, Market Day on the SBS On the Money podcast.
The Australian share market rose today, the S&P ASX 200 up 0.2%. For more, I spoke with Grady Wulff, a market analyst at Bell Direct. Grady, what's driving the market today and which sectors are leading the charge?
Yeah, it's a really interesting day on the markets. Obviously, the US overnight had a sell-off and Europe as well, but Australia really is bucking the trend, and the consumer staple stocks are really doing the heavy lifting today. And that's a sector that generally investors pile into when their fear of an interest rate hike is on the horizon. And that's exactly what we're seeing at the moment, as the stocks in the consumer staples sector are able to pass on costs without their demand being impacted. So that's exactly what we're seeing on the markets today, as investors fear a further rate hike is on the horizon.
Yeah, to what extent is the market now pricing in that rate rise on Melbourne Cup Day?
Yeah, all 4 big banks have said that they are expecting the RBA to raise the nation's cash rate to 4.35%, so a further 25 basis points on Melbourne Cup Day. And that is after, obviously, the hotter than expected CPI data that came out earlier this week. and Michelle Bullock's hawkish comments saying the RBA will raise if they need to raise. So that is what's factored in, as well as the market now factoring in about a 47% chance of a raise, and that's from a market perspective, and that was only 5% chance 10 days ago. So it is very much factored in and increasing by the day at the moment.
Can we talk about the retailers for a moment now? Because I think the retail sales numbers come out next week. We heard from the supermarket retailers over the past few days, Coles and Woolies in their first quarter results. JB Hi-Fi numbers out yesterday. Today was Harvey Norman's turn. It said that same-store sales fell by about 10%. What does this say about the way the consumer is feeling at the moment, even though there are interest rate rise possibilities?
We're expecting consumer spend to come down this year at the start of the year because interest rates started rising, cost of living environment is rising, and repayments of mortgages just kept rising with every interest rate hike. But that really wasn't the case, and we didn't start seeing consumer spend in the discretionary space come down until just recently. And obviously, we're expecting the figures out next week for retail spend, and that will be a key tell. But what we saw is that a lot of consumers had a lot of savings from the COVID money, free money from the government. They couldn't travel, so they had all this money, and now that money is dwindling. So the FY23 results were surprisingly strong for our discretionary stocks. So JB Hi-Fi absolutely knocked it out of the park. But now we are starting to see the impact that we expected to see a little earlier. It's come a bit later, but we were expecting consumer spend to slow down, and we are definitely seeing it now. So cost of living crisis is high. Everything is high. It's a hard time, and the retailers are going to do it tough for the next few months, and until interest rates and costs start coming down, or they can pass the costs on. So the big tell for us will be the Black Friday and Cyber Monday sales, as well as the Christmas period. And I think a lot of the retailers will be hanging for these periods because we know they are the high spend periods, but whether Aussies do spend as much this year, it'll be definitely a tell on just how bad the cost of living crisis is in Australia right now.
And in wrapping up, where do you see the opportunities for investors at the moment, if any?
There's a few opportunities at the moment, and they're kind of underlying opportunities that aren't being impacted by different geopolitical events, high interest rates, anything like that. So one is the energy transition. We're constantly seeing the world continually pushing ahead with this green energy transition, and that's where the opportunities lie with lithium, copper, rare earths, those kind of miners. Then we have the increasing diversion between creating labor and capital. So companies investing in AI to increase productivity versus investing in people to increase productivity. So the companies investing in AI that are really taking a meaningful action to enhance productivity is where we're seeing an opportunity. And the third is obviously COVID pandemic definitely exposed a lot of economies for over-reliance on China especially. And so we're seeing a lot of companies and miners especially really take in-house some operations and processes that they used to rely on China for. So the ones that are bringing them in-house and taking less reliance on China, that's a clear opportunity in the market right now.
Grady Wulff there from Bell Direct. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.